Welcome, everybody. This is SF Live, episode 19. I'm extremely excited about hosting this Fintwit panel today. This is the first time we're doing it, so I'm extremely nervous too, whether all the technology and everything that we set up is actually holding up, right? I'm extremely excited to welcome Brien Lundin, Brandon Macdonald, and Willem Middelkoop, and I just realized I made a blunder there. I missed an L. Jesus, that's my perfectionism is killing me there. Oh my goodness. Okay, I do apologize, Willem. I'll get to you in a second. But first of all, this is an interactive format for everybody. Please use hashtag ask us for your questions. We're going to be talking about market impacts of COVID, obviously. We're going to talk about the gold price. And with Brandon on the board, we're also going to be talking about base metals, infrastructure spending, and how that's going to impact the overall sector. So make sure you follow us here on Twitter to stay alert or get alerts when we go live. Follow us on YouTube and all other social media channels. So without further ado, let me switch over to my guests here. I'm extremely excited to welcome Brien Lundin, the owner of Jefferson Financial, Willem Middelkoop, the CEO and founder of Commodity Discovery Fund, and Brandon Macdonald, CEO of Fireweed. Just one more point before we start. Please let us know if there's any technical issues in the tweet as well. This is the first time we're doing it, so please have some patience with us. Gentlemen, welcome to the show. Really appreciate you coming here.
Thank you.
Happy to be here.
So we've prepared a couple topics, and I'm really excited. We have a newsletter writer, we have a fund manager, and at the bottom we have Brandon, who's the company's CEO. Everybody's really active on Twitter, quite vocal, and I really appreciate that because it's teaching me a lot, and I'm sure a lot of followers and your followers are learning a lot about what is going on in the markets. And this panel also is sort of designed to help maybe make some more sense. I'm personally more focused on the junior space, so this is primarily the focus we're going to be talking about. And one thing we've seen is a lot of spending happening, or government spending happening, and the gold price going to 17. I think we're at 17.14 today. We're a little down today. But I'm really interested in your views and about COVID and Corona and the impact on the industry. But first of all, Brien, how are you doing? You are in New Orleans, if I'm not mistaken, and I hope you're doing well.
Yes, doing well, staying safe, doing pretty much what everybody else is, trying to lock down as much as possible. But doing fine. Trying to keep ahead of these markets, probably working harder from home than I ever did at work.
Oh, tell me about it. Willem, you as well. You're in Amsterdam, or just outside of Amsterdam. I've actually been to your office, and I love the building you're in. Yeah. So it's an old heritage building, if I'm not mistaken. Yeah. How are things in the Netherlands? How are you holding up?
Of course, we've seen huge volatility. March, everything went down, just like the Lehman crisis. So gold went down, gold shares went down, but then we saw an amazing comeback. And actually, we are up 33% since April 1st, and that shows the strong recovery. But the recovery is not very broad. It's the senior producers, the bigger names, the gold ETFs, and the juniors, they always lag. And I think they will do well in the next leg up. And some of the better juniors are already showing quite a bit of advantages.
No, we're going to dive into that topic in more detail in a minute here, because I'm really interested, like how this whole Corona crisis or pandemic is just affecting our sector, the junior mining sector. But Brandon, how are you? You live 10 minutes away from me, but and we haven't seen each other in 6 weeks either. It's like, how are things with you, or how are you holding up?
Yeah, I'm doing well. You know, it's everyone loves their family, and then suddenly you spend 6 straight weeks seeing nobody but your family. And I think my wife and I would love a date night at some point. Sadly, that's not on the cards for some time, but we're coping. We were lucky as a company. We were already doing most of our work from home. So we haven't missed much of a beat. The big question, as we'll discuss later, is, come summertime, what impact that has.
Exactly. Like how is this all affecting our sector down to the nitty gritty details, like the drilling programs that you might be working on as well. Brien, one interesting thing is, like, the gold price has finally moved. It's not where it should be still, in my opinion, and given all the macroeconomic uncertainties and factors influencing it. And one thing I really want to talk to you about, because your history is also in bullion trading and bullion sales, and I really want to talk about the disparity between the gold price and what some people are paying actually for gold coins just to get them and hold them. Maybe we can talk about gold price and that disparity for a second.
Yeah, there was a lot of discussion, I guess, and some arguments on Twitter and in other social media, the way we're all kind of communicating now. when all of this happened, right after the Fed announced in QE infinity, the next QE infinity, there's tremendous surge in demand for physical metals, physical gold and silver in the U.S. and I guess all of North America. And within a few days, all of that, every bit of supply, virtually every bit of supply was absorbed into the market, a tremendous rush of demand. Simultaneous to that, we had some supply disruptions or issues with the spot price in London versus COMEX trading in New York, some mints and refineries shutting down, et cetera. And there was a lot of people, analysts, were kind of conflating the two, and I looked at it as really two different events. One was a surge of physical demand in the U.S. It was not exacerbated by these supply disruptions because they were simultaneous. There was not enough time passing for the refinery shutdowns to have any impact on the supply disruptions or the demand absorbing all of the supplies in the U.S. So they were really two distinct things. And what people need to understand is that physical demand throughout the world is driven by different motivations. In the U.S., it's primarily conservative/libertarian people who are oriented people politically who buy metals. And when Obama was president, there was huge physical metals demand in the U.S. When Trump came into office, it scared the bejesus out of people around the world. But the people who buy metals in the U.S. were more politically aligned with him, really weren't that afraid of him. So we saw physical demand, bullion demand in the U.S. tail off when Trump was elected. And the people who were scared about Trump in the U.S. aren't the kind of people who buy precious metals. So what's happened now is that's kind of flipped. We see the Federal Reserve come in with QE infinity, and all of a sudden, the more conservative libertarian type people in the U.S., people who actually do buy physical metals, are seeing what the potential ramifications of that is, of this huge policy response we're seeing, and they're buying metals hand over fist. So that's kind of what happened. I think that eventually, and we're going to see some of these other supply disruptions have some impact on that. But we're already seeing some refineries get back to work. We're seeing some mints get back to work. The U.S. Mint never really shut down. But there's been a lot of misinformation in that sector, a lot of misunderstanding what's going on. And in fact, in regards to spot versus COMEX, I don't know that anybody really truly understands what's going on, except that something is. And that whole paper gold setup is showing some fragility right now.
It's really interesting because the COMEX couldn't even deliver gold for a while, if I'm not mistaken.
Yeah, they had to resort to taking 400-ounce good delivery bars, and they came up with a system where, okay, you have 100-ounce contracts and you have 400-ounce delivery bars. That doesn't match up perfectly. So they came out with these ACE certificates. I think it's accelerated certificates of exchange or something. But basically, it's a paper representation for bullion for those who are trying to get physical delivery. So they say, okay, you want physical delivery? Here's some paper showing that you got physical delivery. So they're really shuffling things around. And I think more importantly than anything, I think it points to how that whole system is a matter of fractional banking, fractional reserve banking and trading, and how fragile it is. And at some point, I think it's all going to come to a head. Not that it really matters in the long term, because I think if COMEX can't deliver physical, ever really runs up against that wall, it's just going to settle in cash. It's going to change the rules and settle in cash. But I think that will illustrate to the market how tight supplies really are. And I think it'll have a bullish effect on the metals prices.
Really good point. Bullish effect on metals prices. Willem, we're 17.15. Let's just, for argument's sake, use that price. How are you positioned right now? And like you mentioned, you're up 33%. But like, who are the leaders in your portfolio right now? Like, I have the feeling the junior mining sector. Just looking at my watch list here, we're just barely at the level before everything crashed.
I think we're the only fund worldwide who's really concentrating on discoveries and discoveries worldwide. We have seen a lack of discoveries in Canada with the North American listed companies. There are a few. We have ISO Energy, great uranium discovery, TEN Global, new copper discovery in Spain. But if you compare this to the discoveries being made by companies, exploration companies in Australia, Australian listed companies, the grey mining is up 500% year to date. Incredible discovery. Greatland Gold up 400%. But on average, our returns have been helped because we have 40%, 40, in senior producers and ETFs, gold ETFs, silver ETFs. And normally we don't have an exposure like that to the seniors, but we changed our portfolio quite a bit. We started in Q4 last year. We took quite a bit of cash. Normally we don't have any cash, but we were on a cash of 10% late February this year. And then we put the cash at work during the crash, and that has helped our returns. But I think most interesting maybe to note is that we see huge inflow. We've had some 5 million euros of inflow since the middle of March, and that's quite a bit of money. And it's a new kind of investors knocking on our door, literally knocking on our door. And it's more the family office, it's more the guys who made money in real estate, who made money in private equity. And they really want to have an exposure to gold now. And since they can't buy any physical, they're looking for proxies. And they see us like a proxy, and we help them to find other proxies for physical. So that's a big change in the market.
Interesting, and we're going to come to that in a minute. Like, I'm really interested in generalist interest in general. But Brendan, before I want to get you involved here as well, because you're a bit of the outlier. You're the base metals guy here with all these. It's Brien. I think you call yourself a gold bug, and Willem, obviously, you're all more precious metals focused in general. I think your portfolio. How many percent is in precious metals?
It's 75%, and 10% uranium.
Okay. No, and so Brendan, to get you involved, like the whole crash and the corona pandemic, like I think in the US, President Trump, I'm not sure if it's gone through, or it suggested or wants to do a $2 trillion infrastructure spending package. So, and I really want to see like what's the impact on the base metal plays, and you have a further advanced zinc play in the Yukon. What's going to be the whole impact on companies and projects like yours?
Yeah, I guess, when you announce a trillion or 2 trillion in infrastructure investment, and I suspect the total global amount's going to be around 10 trillion, not necessarily all infrastructure, but in direct stimulus. When does that, start to get deployed? Does the metals prices lead the deployment of that capital and the actual demand for metals, or does it lag it a bit? So the question for juniors like us is that clearly, I think, is bullish for base metals. I think the impact of that infrastructure investment will eclipse the demand attrition that we've seen from Corona, at least the long-term demand attrition. The short-term demand attrition obviously is massive because so much has been stopped. But for us, it's great to be positioned for that, but you need to have some momentum coming into it. So do the generalists come into the mining space when they see, oh, look, base metals, there's just not enough out there to meet the demand of what these governments want to do, and do the dollars come in? Nothing surprises me anymore. I suspect that we're going to lead the spending of that money a bit. I think base metals make a rebound, not a sharp one, but probably late this year, early next year, despite the fact that I doubt we see any real infrastructure spending from that sort of stimulus until maybe late next year, probably 2022.
Okay. And Willem, actually, you posted it on Twitter today that copper reserves or copper inventories are depleting in China rapidly right now. Maybe we could comment on that dynamic a little bit.
Yeah, I think we even took part in another round of financing for Fireweed Zinc. So we still put money at work in base metals. It's still 15% of our portfolio, and we concentrate on the best discoveries. And Fireweed Zinc is one of them. Sol Gold is one of them in Ecuador. It's a huge copper gold discovery. But I watched some charts closely, and that's BHP, that's tech. And if you look at the chart of BHP, you know, these are the miners who make their living out of producing and selling base metals. And I think they already turned the corner. They dropped till $30 mid-March. They're around $40 now. So it shows, I think we've seen the worst. And never forget, you know, the amount of money printing and the debasement of currencies just kicked into a higher gear. And people understand this. And so they will flee to all government can't print. And we even saw a new report by the Bank of America upping their target for gold from 2,000 to 3,000 for an ounce. And they even used this title, you know, the Fed can't print gold. I couldn't believe it that this was coming from a Wall Street bank.
They've always been quite aggressive on their gold prices, though. But yes, 3,000 is quite aggressive, and putting that in the title, that's a wake-up call, I'd say, because Bank of America is not a small bank either that nobody follows, right? And Brien, like in terms of generalist interest, you write a couple newsletters as well, and you run an alert service. What I'm really interested in is, like, do you see an uptick in subscriber count? Like, how is the interaction going? Do you even get calls maybe from pension funds or so, just in general, to reach out and see what the situation is there?
And not so much calls from pension funds and the like, but yeah, we have seen tremendous renewal of interest in subscribing to Goldnewsletter and subscribing to our free prospect letter, Golden Opportunities. So we have gotten a lot more interest, and you know, and we do have a significant prospect list that's basically filled from everything from New Orleans conference attendees and Go Newsletter subscribers to people that just click to watch a free video, you know, all along the spectrum. And when we market or expose that list to subscription offers to Gold Newsletter and our prospect list, you know, a couple of years ago, we would get very little response. And now it's worth doing because we get a big response. And these are people who are already interested. I do think that the generalists are coming in. I will be coming in. But right now what we're seeing is this kind of circular firing squad, as it were, where the market's being lifted. Yes, and you're seeing it's almost a tide lifting all boats. But a large degree of it, a good percentage of it, if not a vast majority of it, is all of us, you know, buying each other's deals, kind of seeing what's going on and getting back in the market. And we still have to get that money coming in from the outside. Initially, it's going to come in, as Willem is seeing, in the majors, but it will filter on down the food chain into the juniors. I think it's going to be a process. It's months in action, but it will happen. And there's going to be all the offshoots of it too, into the base metals, et cetera, et cetera. But I think you have to have that gold bull market first before you start getting, at least in the junior equities, a lot of interest in the base metals and some of the associated minerals.
Yeah, let's drill down more on the junior market itself. Like at the Vancouver show in January, I think I spoke to like 4 or 5 new companies that were planning to RTO or IPO in the first half of 2020. I think one has made it so far. Okay, so looking also at the Ornig Index, Ornig is a sister company of Soar Financial here. We track the financings, and so far it's been pretty dead. We've seen a lot of outliers. We've seen Silvercrest raising $101 million. We've seen Bluestone raise $80 million, I think it was yesterday or this week. Mm-hmm. Right? So those are singular outliers, but in general, there's not a lot of financing interest. And now I'm curious, like financing interest at the $1,700 gold price is not there. No new deals are there. So where am I going with this? Like the point is, the activity is lacking in the junior mining sector. And Brandon, maybe you can help me answer that one, or help answer that one. But like, what needs to happen to come back? Like, is it just a time factor?
Yeah, certainly. I looked at, you know, I don't know if time heals all wounds, but we do need a bit more time here. You look at our recent financing, was by design for existing shareholders, but it was filled 98% by existing shareholders, right? I think if we had tried to do a much larger financing and been trying to solicit funds from new investors, it would have been extremely difficult. You know, this was very much a business continuity financing, and I think that people going out to knock on some new doors and get some new investors are going to struggle hugely. Unless you have the intersection of the perfect play for this, a near term or perhaps producing precious metals play. Basically the Bluestones of the world, right? And even they had massive backing from their existing shareholders for that. So I think it's tough. It's funny, in December I was saying that the mood was cautious to nihilistic. In January at VRIC, I was saying that it was surprisingly positive. And then our feet were just kicked up from underneath us with this COVID and market crash, right? And it's been a wild ride. And I think that volatility is probably going to keep people spooked for a little bit until we get some, put together a quarter of somewhat normalcy. And then I think we get some new blood in.
Good point. New blood, I think. I've been saying in presentations before that we need a big scare in the main markets like the S&P and the Dow Jones, and they have dropped now. They're 20-25% at most of them, actually, and the bigger stocks have dropped as well. Unfortunately, the ones like Netflix or Amazon, the ones that are benefiting right now from this whole pandemic because everybody's sitting at home and ordering, are still generating returns for investors. But we need a scare in the general markets to attract more risk capital because we are in a risk industry. And Willem, I'm quite interested in what are catalysts, or what are you looking for? I mentioned new financings or new deals where management teams from existing companies start a new project or a new company. Are you interested in those? How are you allocating your funds when you're allocating your cash?
Well, I'm not that worried, because this reminds me a lot 12 years ago. We were around in 2008, 2009. We started a fund in the summer of 2008, 4 months before Lehman crashed. Then we went down 40% during the Lehman crash. And then we went up 400% in the 2.5 years, leading to the top in 2011. And I see exact the same mechanisms in the market now. First, we went down 40%. March 18, we were down year to date 40%. We're zero now year to date. The recovery has started, and it always starts with physical gold. Then the senior producers start to recover. Silver will lag the recovery of gold, but will eventually take over. And then the juniors will start to rise. We've seen that last week. Today, the Toronto Stock Exchange Venture Index is up while gold is down. So there's a huge breakout on TSX.v compared to the commodity index ratio. We've seen a breakout. And as Brendan said, we'll see huge stimulus coming, and there will be huge investments done worldwide on infrastructure. And so the base metals will also recover, and they're already starting to recover. Look at copper, look at BHP and the majors. So I'm not pessimistic. I'm not so negative.
No, that's very good to hear. And as you said, I actually fully agree. And looking at my watch list, I'm pretty much flat year to date as well with my personal portfolio here. So, and some of the stocks are actually rallying nicely. I wish I would have had more cash mid-March. Brien, you're also sending out alerts to your subscribers. What are you alerting your subscribers to right now? What to look out for right now?
New opportunities. We were buying in March. A bit before some of my compatriots in the industry, because I looked at what Willem has said. He's exactly right. This is a virtual replay. History rhymes and there are differences, etc. The big difference, of course, now between 2008 is the rapidity of the policy response has just been blindingly fast. Not only the degree, but the speed of it all. And so it's a real analog to 2008, where in my presentations, I've been showing the chart of gold in the weeks and months during and immediately after the 2008 great financial crisis. And it's just a jagged EKG line, tremendous volatility, huge sell-offs, tremendous recoveries. And then you look longer term over the following 3 years, and you see that from the lows, the gold price tripled from the lows to the highs. It steadied, and people looked at their policy responses. So yeah, I was heartened by that in the big sell-off, and we started buying some of the companies we were already following, and now we're looking for other new deals. We're starting to see some come out, and we're alerting our readers to some of them. But some of the stocks we're buying a few weeks ago, have doubled since then, and what I've been advising is not exactly what I've been doing either. That sounds worse than it is, but I've been advising people to get in the junior space, at least the ones with large resources, optionality plays, the companies that have proven resources, probably of economics, like the Bluestones, et cetera, because those are going to move more quickly and initially. But I've been looking at some of these exploration plays and telling my readers about it and what I've liked about them. But some of these exploration plays that are funded for drill programs, that I think if you have the assumption that there's going to be some degree of normalcy returning to the exploration market by late summer, mid to late summer, then these plays are going to benefit not only from the typical wintertime lows when they're kind of forgotten, but also COVID on top of that. And they're going to be trading for 2 to 3 times their levels by the time people get excited about drilling starting. And then if you have success in the drilling, well, you're riding for free anyway. So I like some of those and have been investing in some of those. I don't know if we're supposed to mention any names or anything, but
we're an open forum. There's no sponsors or anybody that's prohibiting us from saying anything we want. So.
Okay. Well, I've been buying Millrock, and I'm long that one, so I'm talking my book there. That's one I've liked. I've liked Libero, Copper, and Gold. They're not funded for the next exploration program, but I think they won't have a problem by this summer. I like their exploration projects, and a few others here and there. So yeah, I think it's an extraordinary opportunity, and this sector is going to be lifted. Rising tide, all the boats are going to be lifted, but I think there are some faster horses out there, potentially faster horses.
No, those are excellent points, and I want to circle back just to one thing, like the impact of COVID-19. Like, I'm not convinced that we've seen the last of it. Also, in terms of market response, I think the U.S. so far, which is obviously the leading market in the world, has gotten off lightly. I don't think it's been contained in any shape or form. And the U.S. is a service economy, and so far the service industry is pretty much at a standstill. So Q2 numbers, I'm not sure if they're baked in yet, but I'm expecting more of another correction maybe coming up. Okay, I'm not a macroeconomist; it's just more what I've been reading, what my gut is telling me. Are we going to see another liquidity or a run for the door, another liquidity crunch? And Willem, I might want to address that one to you.
I don't think so. Many people are surprised that stocks are running this fast. But I think the smart money understands the only thing authorities and central banks can do now is print more money. In extremis, it's the stimulus we see now is times 5 or 10 compared to 2008 and 2009, and we all know. So the smart money, they all know what will happen next, and that's huge debasement of currency. And there's a real risk now for the very first time that we could end in some serious inflation or even hyperinflation. We've seen the balance sheet of the Federal Reserve rise by 50% in a few weeks. This
straight up.
Show me one case in history where this amount of money printing hasn't led to hyperinflation or some other very unfortunate events. So there's so much money out there looking for returns. The bond market is you want to put your money in the bond market now. Just for insurance, you put your money in the bond market because it's safer than cash, but you don't go there to get returns. So if you want to have returns, you can go to real estate, but real estate is very highly valued, and the real estate market is a credit market because there's always credit involved. So people can only go to the stock market. And don't forget, if you get some serious inflation, and if this would lead to hyperinflation in 5 or 10 years' time, the best market returns you see in markets where you see hyperinflation. The stock exchange in Venezuela and Zimbabwe went up 20, 30,000%. And I think what we see now on the broader markets on Wall Street might be the first phase of a trend leading towards those kind of risks.
Okay. No, I think those are good points, and I'm still slightly worried. You haven't taken all my anxiety away there. And Brendan, you mentioned something earlier, like pretty much at the intro, and I want to come back to the COVID topic because it's just so timely and we can't get away from it, and it's impacting everything we're doing right now. Since we are a junior exploration company, the impact of COVID, like exploration programs, is like, we're at the cusp of something massive, losing a full year of exploration for a lot of companies. Like, what needs to happen, or like, how realistic is that? Do you see where I'm going with this?
Yeah, look, so there's several things that need to happen in order to have a drill program. First, you need to have the capital for a drill program, which might be a tall order in these markets, depending on what metal you're searching for, et cetera. And then second, you actually need to be able to execute the drill program. This is a challenge, never mind crossing international borders. Even within Canada, in many of the provinces, going from one province to another, you are now facing a 14-day quarantine upon arriving in a new province. So if you've got your head office in Vancouver or Toronto, and your project isn't in British Columbia or Ontario, or all your workers aren't already in the province where your project is, you suddenly are going to have a real hard time executing a drill program. A traditional program might be on a, say, 4-week rotation of people. So what, they're going to arrive 2 weeks early for their 4-week rotation, stay in a hotel for 2 weeks to quarantine, and then go to camp, and then come out, go back home, come back 2 weeks early to repeat. And are you paying them when they're off rotation in quarantine, right? Like, because nobody wants to sit in a hotel in Whitehorse or, whatever for 2 weeks doing nothing without getting paid. So this is part of the reason we didn't raise capital for a drill program this year, was because we weren't convinced we could do it, right? I mean, it's possible before we lose our summer that restrictions are lifted and we can execute a program. But financing for a drill program at the bottom when you don't know you can't do it seems like an extremely unwise thing to do. So, per Brian's point of, liking companies that are cashed up, it's always great to be cashed up, and that's always a good thing to look for in a company. But I'm not sure all the ones who are thinking they're going to have drill programs are going to have drill programs.
That's a very good point, because there's only very few jurisdictions where you can actually drill where you have not been interrupted so far. And I think Nevada, Idaho are a couple of those. Quebec, I think, is slowly coming back, at least the mining operations. Is it fair to say, generalist statement, just play the developers, don't touch the explorers this year? Brien, maybe you can jump in on that one. Oh, we lost you, Brien. You're
muted.
You're muted yourself somehow.
I am unmuted. Sorry, I was polite in muting myself. No, I can't say that because I'm not doing that. I'm looking at it case by case, and we do cover a lot of companies, frankly, probably too many. But I am looking at it as a case by case basis, and I don't think you can apply that generalization. But I think there is logic to that. And there are other things to look at too. It depends on whether you're a trader or an investor, and I think that's what it comes down to. If you're looking at the cycles in these markets, if you're truly speculating, there are some drill hole plays out there that will be drilling at some point, or actually have core that was drilling programs that were cut off by COVID and have drill core in the lab, some drill core at least, like Millrock, which I just mentioned. So it is a case-by-case basis. Now, if you're looking at playing these cycles and looking at the longer term, there are opportunities now that if you look a year down the road, when you hope that there's some economic recovery and you see that some of these supply disruptions watching right now are going to hit the markets, then you want to look at the base metals because they're going to follow gold. And I do think that a gold bull market is a prerequisite, but I do know that, you don't have a zinc bull market, you don't have a copper bull market unless there's an underlying gold bull market. And we have that in place now. We are going to have some kind of an economic recovery that's going to run head on into some supply disruptions. So I think zinc and copper are great things to look at now if you have a time frame of a year down the road or thereabouts or a little bit further. And I think uranium as well is perking up right now. So we're about to start getting back into that area in Goldnewsletter. And there are obviously some events going on there, and the price is perking up. So I think we're still early there as well.
Okay, let's switch over to Twitter. And Brandon, stop liking the tweets while we're chatting here. So we got a few questions, and people can see questions here on the screen as well. And everybody knows Cooper Quinn probably, and he's very active on Twitter as well. We probably should have him on the show at one point or another as well. Couple questions that came in, and we're just going to go through a few because we're running already a little bit long. We're at 36 minutes right now, which is great. So we got probably 5 to 10 minutes answering some questions. First question is addressed to you, Brendan, actually, and we know your feelings on pants if we all follow you on Twitter, but it looks like you're not wearing a shirt. Also coming to the base metals, how long do you think zinc and lead producers currently underwater will be able to stay in production? What are the implications for development stories?
Yeah, I guess, I had been posting on Twitter about this recently that I figured on a cash basis, 30% of the zinc producers are underwater right now, or zinc mines. Once you add sustaining capital, probably closer to 50%. Now you can put off your sustaining capital for a bit, but that tends to come around and bite you in the ass if you put it off too long. I don't know how long. You've already seen some closures, some related to COVID, some just purely financial closures. So another 6 months of this before there's massive supply destruction, I think is who knows? It seems like the longest it can go. But the question for development stories is, okay, does this shake out the weakest of the producers and leave a gap or a space for a better developer to take their place, right? A lot of these restarts were questionable in terms, they were restarting into what was a zinc bull market, hoping for prices in the sort of 120 per pound plus. Are they going to restart again the instant it gets to 120, or are people going to look at development stories that have cash costs in the 70s and 80s? I think assuming, this is a big assumption, I can get the capital to get my project permitted and engineered, I think this is good for us. I think this shakes out some competition and creates more tightness in the market. But that's a big question mark whether, during a period of a low commodity price, whether anyone will fund you to develop your project.
Yeah, no, I think it's a wait and see kind of approach, unfortunately, I guess, right? Willem, I think the next one is a good question for you. It's from Bernie Kraft. And the question is because you're a discovery investor, you like chasing discoveries, so that question is perfect for you. What is the short to medium term future for early stage grassroots exploration? And then maybe a little more technical, what kind of deposit types would be of interest?
It's very hard to give a general answer, I've been a discovery investor for almost 20 years now. First as a private investor, then as a fund manager. And the longer I'm in this business, the more I am convinced that I should focus on only one thing, and that's the truth machine. That's the discovery hole. That's the confirmation of the discovery hole. And we started to disinvest in Q3 last year, the tier 2 discoveries, the tier 3 discoveries. We only focus on the most promising ones. And I don't mind if it's gold or copper or uranium. I don't mind if it's a CDEX or I'm not even a geologist, I don't even understand it. And if you really stick to next gen for uranium, to soul golds for copper, to the gray mining for gold and great bear resources, you will do well. And even in times like this, and I remember this from 2008, 2009 as well, the best exploration place, the best discovery place, I should say, they run like hell after a crash. I love crashes because you're done, and nobody is leaving. We don't have redemptions because why would you leave at such a low level? So the only way is up, and we have our best month ever now, 33% up. But during the recovery in 2009, we had 6 out of 12 months with double-digit monthly returns. Same in 2016, the recovery. We had two months of over 20% returns. So if you stick to the best, and I'm sorry, for all the juniors out there who aren't so lucky that they have the world-class discovery, but I can be opportunistic asshole and choose the prettiest girls out there.
Well, that's the luxury of being on the buy side, right? That's the opportunity,
Yeah.
and you dictate the market, right?
Yeah.
One point actually, like the deposit types, you mentioned you're not just looking at gold and silver. What other opportunities are you looking at? And there's a question from Sean Broderick. What's an economic opportunity besides precious metals that most people are overlooking right now? I think that's a question for everybody here.
Yeah.
So maybe, Brien, is there something else you're looking at besides gold and silver right now?
Yeah, I kind of answered that before, and Brandon can pay me for this later, but zinc is a great play right now. Copper is, if you have a longer time horizon, and we've been recommending Fireweed from the jump because I think it's one of the best, probably the best exploration development play out there in that area. And at these levels, if you buy these companies, some of these better base metal companies at current prices, and you're willing to hold them for a year, 18 months, I think you're going to be greatly rewarded. But again, the prerequisite to all of this is having a buoyant gold market, a bull market in gold, and then in silver, because that brings the speculative investors into the junior equities. And when you have that kind of a run, like we had in the early 2000s, you had a great run in gold and silver. Then we had rare earths. Then we had uranium mania. We had all these offshoot markets, and people were looking at copper plays, zinc plays, and the like. And I think that's what we're getting into. We're getting into that kind of a market atmosphere over the next 5 years, I believe. And we expected a lot of things to happen over the next 5 years that surprisingly happened over the course of about 5 days. So everything's been compressed. It's been brought forward. Getting back to your other question, I think it's very likely we're going to have another downturn, another dip. But I think if you're looking at playing this cycle, you get positioned in the better plays and peck away at them right now, and keep some ammunition on the side. So if you do get that kind of further downdraft, you can get back in again.
Brendan, you're also in Vancouver. Unfortunately, we can't walk the streets, but what do you hear on the streets besides copper, like gold, silver right now? Is there anything else you're picking up? Are you hearing about any new plays or companies popping up, or even new metals that are becoming hotter right now?
Yeah, I mean, look, that there's the uranium bulls are finally getting their their moment in the sun. You guys could perhaps speak more to this than me. It strikes me that this is a short-term structural issue in uranium. I'm not sold that it's a long-term thing yet. Not that I'm bearish uranium, but it's certainly a good play right now. Look, everyone's really very focused on the precious metals, particularly gold. And I was saying at PDAC that I had a few people tell me like, contrarian investor, I've been in gold. And I'm like, well, come on, like gold's 1,700 and you're calling yourself a contrarian investor, right? Like that's not Yeah, exactly.
Zinc.
Try zinc, and I mean, yeah. So but I don't think that's necessarily the wrong thing to do because the juniors are not valued like gold is 1,700, right? So whereas you could say the zinc juniors are more beat up, and will probably have a bigger bounce. There's a question of who moves farthest and who moves first. Both are important. You could argue that the zinc juniors might move farther, but the gold juniors are going to move first. And if you're a good trader, maybe that's where you should be.
That's a very good point. And I think it's time to wrap this up here. And I want to give everybody like 30 seconds sort of for like an outlook. Like, what are you doing or what do you suggest to do, giving everything that's happening right now in the net to do for investors in the next 3 months, just so we put a bow around what we've been discussing. Brien, since you're at the, well, here on the screen, you're on my right, but you're on my left. I don't know. So why don't we start with you?
Well, I think I've kind of covered that. Just to reiterate it, we're in an extraordinary environment here. It's unprecedented yet again. Now, one concern I have is that in 2008 we had this tremendous liquidity injection, and we did not see resulting economic repercussions. We didn't see retail price inflation. It was all kind of captured in the financial markets. I think we'll need to see that this time for gold to maintain its bull market. But the good news is I think we will. I think that will happen. And even if it doesn't happen, we're going to have a couple of years of a rising gold price. I think the nominal record of 1920 or thereabouts is going to get broken over the next 6 months, probably. Probably good chance it'll be sooner than that. I think we're going to get well into the 2000s on the gold price. In that kind of environment, you want to be positioned in the better juniors. And some of them have had runs, but they're still small fractions related to where I think they're going to end up. So I think, be careful, be prudent, but buy these things, buy the bargains that are still out there, the companies that have that are fairly well cashed up and are going to be advancing in this environment.
Fantastic. Willem, what do you got for us?
Well, as you know, I'm also an author of books, and in 2014 I wrote A Big Reset, and on the back cover I mentioned that around 2020 we'll need a monetary reset. We need to find a new anchor for world's monetary system. We need to get debt restructurings worldwide, and we need a gold revaluation. Well, the governor of the Bank of England recently said we need to build a new monetary system because the dollar is in its end game. The United Nations this week said we need a new world body looking after debt restructurings. And I think we could have a revaluation of gold to help the central bank balance sheets. Italy has a huge gold reserves. If you revalue gold to a much higher level, not only Italy will be helped, but it will also help the Federal Reserve. And what happens now on the COMEX markets could lead to a reset of the gold trading system and could lead to a gold revaluation. So I think investors will be pleasantly surprised what will happen with gold and silver related investments.
You made a couple of really good points that I could go hours and hours on. Like revaluation of gold to cleared balance sheets is a fantastic topic we could speak on for hours. But we don't have the time. We're running out. And,
next time.
Brandon,
next
like
time.
From the junior mining aspect, what you got for us there? Like what should investors look for? How should we play this?
As an investor, I'm paying attention to management teams because, I also invest in this space that are keeping it simple. This is not a time to get too fancy with your strategy because there's too much strategic volatility, not just market volatility, but strategic volatility in terms of how fast the situation is changing. What was very clever yesterday becomes very stupid tomorrow. So be aware of who's promising to execute something that they might not be able to execute, even though it might seem fair now. But keep an eye out for you barely need to keep an eye out for the bargains. They're everywhere. But the most, per Willem's point, the highest quality plays will move first and move farthest. You may consider there's more torque in the marginal assets, but that's really a fool's game, right? So look for the high quality plays where the management has a steady hand.
Fantastic. I think that was a great wrap up and to our discussion here. I really appreciate everybody's time coming on here. Willem, it's 8 o'clock for you almost in Amsterdam, and Brien and Brandon also as well. Really appreciate it. Thank you everybody for listening. Make sure to subscribe to our Twitter channel. We'll be uploading this video also to YouTube later on, and you'll be able to download this as a podcast on Spotify in the coming hours. So thanks for tuning in. Everybody have a good weekend and stay safe, please.
Okay, bye there. Thank you.
Thank you.